Welcome to Tim's Strategy of the Week series. Today we're going to talk about trading 4-hour charts, and I'm going to show you the Doji sandwich. Stay right where you are. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment of the Strategy of the Week. Today we're looking at another simple price action pattern strategy that I think you'll like, and we'll talk about trading 4-hour charts. As many of you know, I like to trade the daily charts. It gives me lots of time to look at charts in a leisurely fashion and get ready for my 15 minutes or so of actual work each afternoon. The downside of the daily chart is the stop losses are pretty big, so you have to have a large enough account to be able to take a decent trade size. And you'll typically end up in the market for many days, so you're more exposed to unexpected market shakeups. I don't like much of the shorter time frames because I end up sitting and staring at charts all day waiting for something to happen, especially on time frames less than an hour. But the happy medium between all of these is the 4-hour time frame. You can anticipate when you have to look at your charts, and you can easily set timers and alerts to be sure that you don't miss anything. Since it takes 4 hours for a candle to form, you have lots of time to do other things in between chart sessions. Plus, the stop losses will be more reasonable and you can use larger trade sizes. One caveat with the 4-hour chart is that different brokers may start the 4-hour candles at different times, often based on the broker's local time. That will cause the charts to look different from broker to broker. When I hosted trading rooms, we often ran into the situation where my 4-hour candles were different than someone in the trading room, and that just became confusing for everyone. So, understand that if you decide to use 4-hour candles, your signals may be different than one of your friend's signals. Not only will they be shifted by an hour or more, but you may not even have a signal when your friend has one and vice versa. With all that said, today's strategy is the Doji sandwich strategy, and I suggest you try it out on the 4-hour chart. It most probably will work well on shorter and longer time frames, but the 4-hour time frames will give you your life back and still allow you to trade a smaller account. If you've followed my Wednesday videos, the Trading Education series, or if you've just been around the block a few times, you're already familiar with the Doji candlestick. To be sure we're all on the same page, I'll review the Doji briefly. While the Doji is almost never symmetrical, its main characteristic is a small candle body where the open and close are very close together. How close together do they have to be considered a Doji? Well, I'm going to answer this question the same way I answer similar questions. They need to be close enough together to be considered a Doji. I don't mean to be a smart aleck or anything here, but there is no rule regarding the distance. Like most everything else in trading, it's kind of an eyeball thing. You look at it and decide it's a Doji, just like you look at other patterns and recognize them. If you have two massively long wicks, then the candle body can probably be a little bit larger and still be considered a Doji. Everything is relative. What your job as a trader is to set the rules as to how big the body can be, and that will be your line in the sand. If you follow my Trade Picks videos, you know I draw lines on candlestick patterns that are pretty flaky sometimes. I know the lines are flaky, but sometimes I'm drawing them on flaky candlestick patterns. I love beauty and symmetry as much as the next guy, but I stick to those things in my other artistic pursuits. If a candlestick pattern vaguely resembles the pattern I think it is, I draw the lines. The Doji is the same way. Look at it in the context of the candles around it. If the body is significantly smaller than the surrounding candles, then you can probably classify it as a Doji. I hope I'm getting my point across. To paraphrase the popular idiom, Doji is in the eye of the beholder. With that said, there are many variations on the Doji, including many of the named candlestick patterns like the hanging man, shooting star, the harami, the inverted hammer, the dark cloud, and so on. Since the strategy is the Doji sandwich, I'll bet you can guess the next part. We're looking for a 3-bar reversal pattern with the Doji in the middle. It will consist of one large candle that closes near the higher end or lower end of its price range, followed by the Doji candle, and then a third large candle of similar magnitude as the first candle. The third candle must be in the same direction as the first candle. This is the pattern we're going to be looking for. For confirmation, we're going to be using the stochastic indicator with the default settings. Here's an example of the setup on the US dollar, Canadian dollar. The first and third candle are more or less the same length and point in the same direction, and of course the meat of our doji sandwich is the doji candle. There are two ways you can enter this trade. You can buy as soon as the fourth candle opens, or you can wait until the high of the third candle is broken. Whichever you choose, be consistent from trade to trade. Experiment with them. The first is likely to net you a larger profit on the winners but have a smaller win rate. I also suggest you add the 50 and 200 simple moving averages to the chart to get additional guidance on the trade. In this case, since the trade is significantly below the 200 SMA, you can think of it as a shorter term trade, since moving above the 200 SMA is a pretty significant event. Ideally, the price should break above the 50 SMA during or shortly after the doji sandwich pattern forms. If the price struggles to get over the 50 SMA, you may want to shut your trade down to keep your losses small. As for your stop loss, you can initially place that just below the doji candle, as the trade setup is negated if the price drops back below the doji. You can then move your stop above the 50 SMA after a candle closes above that level. For your take profit points, if your buy trade is below the 200 SMA, you'll want to start looking for a profit point if the stochastic becomes overbought. If your buy setup is above the 200 SMA, you may want to trail the stops just below the pullbacks as the price moves up, or you can use another indicator like the parabolic SAR to trail your stops and allow you to get a lot more profit. You can find more details about the doji sandwich in the blog post. I'll put a link in the description below. And that's it for this week's strategy. Be sure to come back next Wednesday at 3 p.m. as we discuss the volume indicator in our trading education series. Also, don't miss my trading picks of the week on Mondays and my strategy of the week on Friday right here at Trading Strategy Guides YouTube channel at 3 p.m. New York time. Be sure to subscribe and hit the bell so you'll be notified when these videos come out. Have a great weekend, and I'll see you with a couple of trade picks on Monday.